Welcome back to Decode. Today, we are cracking the code to a 10 crore portfolio. Yes, you heard it right. Nearly $1 million in today's terms, with Shyam, who has envisaged the $1 million milestone program here at iThought. Hi, Shyam.
Hi.
Hi. This $1 million is a nice number today. It's almost 10 crores rounded. Now, we did a survey recently for the Financial Freedom Day, and a lot of people have given their freedom number to be in the 1 to 10 crore range, and the upper limit is 10 crores. Now, why is this 10 crore sweet spot, and why are you targeting 10 crores?
Today,
Yes.
firstly, let's start with the $1 million number. I like this number. I liked it even in 1990. The reason I liked it is it's a global metric. So when I started investing, I wanted to first go to 1 crore. And from there, I wanted to go to $1 million.
Yeah.
How much $1 million is in rupee terms changed from 1.5 crores
Yeah.
when I started investing. It went to 3 crores and then it has been growing. Today it is very close to 10 crores. So the sweet spot of 10 crores today comes from what is today very close to $1 million. So when I set 1 crore as my goal, I thought with another 50 lakhs I would reach $1 million. By the time I reached 1 crore, $1 million was close to 3 crores. So it had literally doubled. A lot of people who started investing with us started when $1 million was 6 crores.
Okay.
Today it has moved to 10 crores. But I still think that you should stick to the global metric. Because wealth in global terms, when you measure, I think that you won't be caught or you won't be left behind. When you want to, let's say, change where you want to live, when you want to have the choice of living in another country, in another society, then when you have money in a global metric, you are ready to fulfill that choice whenever you get it. So I like $1 million as a metric. And today 10 crore is as close to that metric as can realistically be. I don't want to err on the other side.
Okay.
So you have 50 lakhs on the other side.
Okay.
And that's why 10 crore is important today.
Okay.
It need not be 10 crore forever. When I started, 1 crore was the metric because 1.5 crore was $1 million. It was very close to that. But then what experience has taught me is that the $1 million milestone in rupee terms keeps moving away.
Yeah.
So you need to move towards it and play catch up.
Understand. Now, often when we hear of such a big number, most of us tend to think that, probably this person has had a windfall. Now, that windfall, to a certain extent of the portfolio at least, this windfall can be typically ESOPs, successful startups of which, out of which you've got some money. It could be some family wealth and so on and so forth. Now, for example, you were telling us last week when you went to Bangalore, you met an investor who had reached 1 crore when he was 31 years old. And later on, you added saying he had 40 lakhs of ESOPs.
Correct.
Yeah. So when I think of myself, I have not had any of this in my professional life.
Pure compounding.
So I tend to think whether this is something that is applicable for me, or is it, for somebody else who has had such luck in life.
Windfall or no windfall, I think it's applicable to everybody. I'll tell you why. So I'm going to draw on my own experience because I think I have not done it just for myself. I've repeated again for my children in mutual funds. So this first crore is very, very critical. So when you go towards the first crore, you set yourself up for bigger things. Your behavioral patterns emerge, evolve, and they settle down. Your investment habits strengthen, and the outcomes play out. All this happens in this journey. In my assessment, for somebody to go to 10 crores, it's enough if he saves 25 to 35% of that sum. 2.5 to 3.5 crores is all that person has to put as his money. The rest compounding should do. And you should give it maybe 1 or 2 cycles maximum.
Okay.
So actually, I feel the playbook is fairly simple even today to me, and it is very much doable by you. You should see it. If at all you are not seeing it, it's because you are attributing windfalls and other things happening to others and thinking whether it will happen to you. Assume there are no windfalls. I'm actually not going to assume there are any windfalls. You still have to have a playbook and a behavioral roadmap to save that 2.5 crores over a career span of 15-20 years.
Yeah.
All right. If you're going to do that, compounding will do the rest. So even without any windfall, this number is doable for anybody.
Okay.
Like I have done 1 crore for each of my children. I have put only 27 lakhs. All the investments have been only in mutual funds. I have not bought a single direct stock. But it's taken us, let's say, 15 years. Through the life cycle of I thought this has happened. And I actually did serious investing for 6-7 years only. Let's say 2019 to 26 only, I said, okay, let me do something for the kids. Till then, I didn't even think about it. I said, where's the need? Anyway, we can give. The typical, let's look at this later attitude. Even I had it. But when I started focusing on that portfolio, put a number, did something monthly, did something annually, measured what I did monthly and annually, all in terms of savings. Every year. Then I started seeing the outcomes play out clean. Now they are above 1 crore. Now I need to basically keep saving for them. I've saved only 27 lakhs and they're at 1 crore. I still need to keep saving for them as much as I can. And let's see where it goes.
So I have 2 questions from this. You're talking of a savings number. Now, I'll go back to my example because I would like to relate to this $1 million milestone a lot more. Now, if you look at my portfolio, I am not an 100% equity person. I've always had asset allocation towards debt, tactical allocations. Now, after target maturity funds came and yields were high, I used to do that, corporate FDs with good rates. All these things I have done. So, net, my equity at a peak would have been 70 and debt would have been 30. So, it's usually 60-40, 70-30. Now, do you think doing debt would be an impediment to this $1 million milestone journey?
Nothing is an impediment. It will just take you longer to reach there, that's all. See, I believe that debt is a tactical asset, just like gold or silver. Okay? Equity is your primary asset. That's how it should be. Because if you don't have liabilities, you should make equity your primary asset. So it should be a driver. At no point should it go below 60%. It can go even up to 80 or even 90% sometimes. When it becomes too good to be true in your equity portfolio, then make tactical allocation towards debt, silver, gold, so that you protect yourself against a drawdown. That's how I would look at it. By doing that, you will safeguard yourself reasonably. Generally, what most of the people do is that they stick to the same asset allocation almost. If you look at your asset allocation across, let's say you would have invested for 10 or 15 years, please go and plot your asset allocation at every year end, because at the time of filing tax you would have known. Take the year end asset allocation and see how much variation has been there. YOY across. Just plot one graph over that period. You will see a very interesting thing. You would see mostly that your asset allocation has been static. You are thinking it's dynamic, but most people have it static. It should be more dynamic. For example, in my opinion, gold and silver ought to have been sold at a particular time, ought to have been bought more at another context. You need to think out of the box. I'll give you an example. 3 years back, I felt that rather than buy small cap equity, which is the accelerator for returns, gold and silver could be that accelerator. So actually I am doing tactical asset allocation, but I am also looking at something which can take my portfolio higher and faster. Because it has not had a bull run in many years. Sometimes it could be large cap equity. Like today, if you are going to have a top-down trade in India, large cap equity could be the driver which will give you that asset allocation alpha. What you can get more out of asset allocation. So you need to look at the context and adapt your asset allocation, and in that there should be a decision which drives that asset allocation. There should be something which is forward looking. Mechanical asset allocation won't help. I think most asset allocation, and you will agree, you've seen, is mechanical. I feel that it's mechanical. When it becomes mechanical, become clinical, then outcomes are also bound to reflect that.
Yeah.
So you need to somewhere bring in some innovation into what you do.
Okay.
It may be only to 10-20% of your portfolio. I'm not saying that you sell all your equity and buy gold and silver in 24. That's not my point. I was looking at people buying, let us say, between 7.5% and 10% of gold, 7.5% and 10% of silver. Instead of small cap.
Okay.
Right? Each went up by 100% in 2 years.
Yeah.
Right? Instead, what are we doing? We are looking at 10-year return of small cap. Therefore, you should sit there. So the asset allocation completely missed out on what it needed to do.
Okay.
This always happens in this asset allocation approach. Inside asset allocation, there has to be something which is a driver. You will have to ask yourself, okay, I've got 60% equity. What is my driver? If I don't have, I have to create that. Then, let's say, can I increase my asset allocation equity from 60 to 70 because assets are really cheap, equity assets. Let's say everything is expensive. At that point, you say, can I reduce my equity and move to some other assets like 2024? I gave you the example. This asset allocation model has to be tied into the asset prices to valuation.
No, I understand. So what you mean is, if the metrics warrant that you could be 100% in equities, you should be doing it. That's what you mean.
Generally, 100% no metric will warrant, but let's say 80 or 85. It could, no?
Yeah.
In a big bear market, it could, no? Why are you sitting in some target maturity or debt when equity assets are very, very cheap? I wouldn't do that, because that opportunity is once in 10 years.
Okay. Yeah.
At that time, if you are going to put forward investment theory and asset allocation, I feel it's you're losing that time. Okay, you are consciously given away your compounding time to a mediocre asset. I won't do it.
Okay.
Why would I?
Yeah. The other question I also had from what you said earlier was the fact that, you said it very easily that anybody can do it.
Yes.
But most people don't realize their own potential. I'll go back to my own example. So when I decided to start investing with, I thought, what happened was the RM came to me and said, ma'am, I think you have the potential to be an Accelerator client. Why do you, I was not too keen. I was like, am I? Should I? You think I am? I don't think I can put in so much. She said, no, you can. You have the potential. You should be able to do it. I will tell you how to do it. You just leave everything to me. So you need the nudge from somebody always. So, how do you make people feel that they have the potential? Most people tend to underestimate their own potential, isn't it?
Everyone does. Yeah. I still tend to underestimate my potential at times. I learned to actually reevaluate at a reasonable frequency whether I am working to my potential. We have to always do this. Before I do that, let me explain what this accelerator is, because I think many people may be wondering what this jargon is. An accelerator is an approach where an investor puts in 1 lakh rupee every month through an SIP, an equity, and a mix if required in debt also. So that money becomes his annual driver as 12 lakhs. Over and above this, he puts some lump sums whenever he can. And what happens is this 1 crore gets broken down into a 5-6 year journey. So it's very fast. And anyone earning 3 lakhs or even 2 lakhs can take this approach. So I'm first trying to set the speed at which somebody who earns 2 lakhs salary, either individually or collectively as a family, that is double income of 2 lakhs, accelerates to savings of 1 crore. This is my primary target. Because once they do this, it becomes a playbook for them. 7-8 years, they're going to save 1 crore. Next 7-8 years, they'll probably save more. So you see the 2.5 crores, which I said is what you need as the base capital for $1 million. In 15 years, somebody would have done this, even if they can save 1 lakh. So the accelerator concept basically sets people on that path and keeps them focused on what they need to do. And you don't get distracted by the market, by so many other things, by wars, by elections.
And it accelerates your journey towards the $1 million milestone.
You said, no, I was thinking whether is it for me. So when you start thinking like that, is it for me? Am I the one to do it? This thought process is not unique to you, firstly. Let me clarify. It applies to me also. When I got into private equity investments, I was thinking, how much should I put? Let me just put some token amount. Then I said, how will it move my needle? When I started investing money in real estate, I was just buying some random things that came my way. Then I said, no, this is not the way. I should set a corpus that I need to invest and then decide where I should invest that corpus and then decide what I'm going to get out of that corpus and invest to my plan. So for everything, there has to be a clear plan, a playbook by which you make your investing, do what it needs to do for you. So everybody can do it provided you have a playbook. And the playbook should not be complex. It should not be esoteric. It should not be something you cannot explain to yourself. For example, I would not put any money in any approach which is heavily dependent on momentum, heavily dependent on trading, equity trading, heavily dependent on functioning like a hedge fund. I won't put all this into my retirement corpus. Okay, however novel the product may be, I would step back. Because I want to use pure equity as an asset class to create alpha for myself and for whoever I work with. I don't want somebody else's failures in risk management to become a life problem for me or for anybody. Right? Like that, you need to have some clear principles.
Okay.
So you need to have targets. You need to allocate capital to your full potential. You need to save and invest your full potential, and you must ensure that behaviorally there are no risks that are there in your approaches.
Understand.
Not only your behavior.
Yeah.
Manager behavior also.
Yeah. Okay. Okay. So you did touch upon asset allocation and real estate also. The question is, many people tend to think, mutual funds are far too simple to go towards $1 million milestone. You need some of the exotic stuff, and the exotic stuff could be, as simple as a PMS. It could be AIF. It could be the different forms of real estate investments that we have today. We have at least 2-3 versions of real estate investments that we could do, and so on and so forth. And many people may tend to think that debt may also decelerate their progress, and so they shouldn't be high on debt also. So, I mean, how should one look at it from 1 crore to 10 crore? So,
see, 1 crore to 10 crore is actually a kind of a steep climb in our minds. But actually, you are saving from 1 crore to 2.5 crore. Rest compounding should do. If you are going to look every month, every day, every hour as to what's happening in your portfolio, this journey from 1 crore to 10 crore is going to be very, very difficult for you. Because you're going to be very judgmental, you're going to be more reactive and probably less patient than necessary. So, you have to actually understand that your job is to save the next 1.5 to 2 crores or 2.5 crores, between 1.5 and 2.5 crores of savings. Let's say your savings potential per annum is 25 lakhs, it's 10-12 years of savings.
yeah.
Correct? Maximum.
Yeah.
Maybe another 2 years, 14 years. But if your income is going to grow, this between 10 and 14 years shrinks to somewhere between, let's say, 8 and 10 years.
Yeah.
That's all you need to save. Compounding does the rest of the job. Now, whether you're going to reach that spot by the time you finish saving this money, which is the 10th year, or you're going to give a few more years more, is a function of how good your compounding is working.
Yeah.
And that's a function of how good the market is, giving opportunities. That's a run rate of the market.
Yeah.
You're not, somebody who can really become phenomenally rich, irrespective of where the market is going. Chances of that happening are very low for most people. Let's accept that.
Okay.
We are a function of the market. We try to do better than the market. This is the space that we are trying to operate in. So, when people only focus on what they need to do, which is add that extra savings, then they're fine.
So you're saying you could probably leave the product choices to your advisor or your manager.
See, firstly, I feel that everybody is obsessed about cost. Okay, this cost obsession can wait. Look at, be obsessed about how good your process is working, how clear the benefits are. Are you able to visualize the benefits, or is it something that you can't see? How simple is the structure of working? When you see all these things, then you can trust a manager or an advisor, whatever. Basically, I like to keep my investing simple, whatever investing I do.
Okay.
And it can be done simple, whether in direct equity or in a mutual fund. It's not difficult. When I say mutual fund, it could be active or passive. It's entirely up to you. If your passive choices can give you higher returns, it's fine. But generally, I've seen that passive choices are high single digit return products. Generally, for most people, that's the experience. And active choices have to be at least low teen,
Yeah.
right?
Yeah.
Returns, that 12, 13,
Yeah.
14%. So between high single digit and low teen, somebody has to do the work to deliver.
Yeah.
And it is not work which is done only at the point of choosing the funds. Let's not confuse ourselves, because you need to do a lot of things along the way. I'll give you a simple example. In the way we work with investors, every week we are giving them one investment action, at least one in mutual funds. In addition to this, every month there may be one or two extra investment actions. So you just think about it, 52 investment actions plus maybe another maybe 40 or 50 investment actions if the market gives you the opportunity. So the investor has to participate in all of these to his best capability. Doesn't mean that you have to put big money every time somebody calls you to action. So all this adds up. It's not just the choice of fund. Now, if you can do it yourself, fine. But if you're having the hand holding like somebody like us and do it, that's also fine. I'm not going to become judgmental on how a person chooses to do it. But I would definitely be judgmental about lazy approaches because it won't get you there.
Okay.
See, what is today's narrative in the investment world? It's very easy. It's very simple. Nobody else can make money. You can do it yourself. This is all you need to do. So they reduce what you need to do to very few things. I don't think investing is such a simplified discipline as today's
it's made out to be.
Influencers make it out to be.
Yeah.
It is definitely more, it involves definitely more hard work. It's definitely more nuanced. I missed that word earlier. So it has nuance, it requires hard work. All that if you can do, fine. If you can't do, then I think you need hand holding.
Okay. You also briefly touched upon behavior. Now, here in our Milestones to Wealth program, we say that we will set your behavior right so that you reach your path to 1 crore smoothly. And my question is, from 1 crore to this $1 million milestone, is the replication of the same behavior is what is going to take you? Or do you think investors tend to make new mistakes when moving towards this $1 million milestone? The
belief is that in Milestones to Wealth, we will be able to set behavior at a base level and improve it later.
Okay.
So we'll have to work hard with the investor. It's not a joke. Just because somebody came to 1 crore, it's not as if all the learning is over. Actually, learning never ends. I still learn as an investor how I can go from where I am to the next level. It's a hard grind. It's not an easy thing.
Okay.
We revisit what we learned. I keep telling you about how my first crore was. And I compared with that young boy when I came and told you. Because I reached at 28 with, I did very, very well, I thought. But here was a young kid with so much fire, right? He has achieved it. Now, he had ESOP to the extent of 40%, the balance was from his compounding. Whatever it is, I give him full credit. I think it's a phenomenal thing at 31 for a young kid with no financial background, with a family which has never been financialized, to come to that 1 crore. I think that was phenomenal, right? But then, when I met him, what struck me was, he is clearly aware that he has to do much more to get to the next level. Not that starry-eyed ambition saying that I will do 100 crore. A lot of people talk like that. But here he gets the nuance and he understands that his behavior has to improve. Right? And that's something I would think at his age, even I was not as clear as he was. I mean, for me, it's evolved over time. Right? I must have made a few mistakes after that also. But I think that if a young person can be like this boy I met, rather than experimental like it was in our times and it is today on the platform. Because you look at the platforms, everybody is experimenting. This kid is not experimenting. So I think that it's better not to experiment and just go on a set path, keep improving your behavior so that behavior becomes your primary wealth driver.
Okay.
That's what we are trying to do in this. Why we are emphasizing it in the first 1 crore journey in Milestones to Wealth is, I want it to be a foundational program for people to think way beyond what they otherwise would.
Okay. Understand.
Okay, I'm going to flip and ask you a question. Now, Are you still hesitant to think of a big number yourself?
No, the point was I never thought of a number. I never put a number, although I was saving very diligently. I said, yeah, let it go as it goes.
Okay. Here, I think that you should,
Yeah.
we all should break that
Yeah.
shyness about a number.
Yeah.
What happens when you think about a number is not generation of a pompous attitude. You actually become more diligent
That's true.
in moving towards that number.
Correct.
That is what a good number or a big number should do to us.
Yeah. Yeah.
Not make us talk too much about the number to others, or it is to ourselves that we tell that I have to go there. So what am I doing now?
Yeah.
What should I do? Is what I am doing adequate? It's to create that mind play
Yeah.
that a big number actually helps.
The other side to this story is also the fact that since, I've been in the same industry, writing on the same things and now talking about the same things, I know the slip-ups that can happen, number one. And number two, I also know that you need such a number. Now, there are a lot of people who are unaware of even what number is a good number. They end up thinking 1 crore is the ultimate number. Like, for example, if I tell, say, my parents or somebody, see, I am looking at this number. Like, why? Why do you need so much for retirement? Like, do you think you need so much? See, we are all living without that only. So, that kind of an attitude is there even among the youngsters today because they are not actually thinking in terms of
See,
what
they
should
say
be
this
enough.
even for 1 crore actually.
Yeah, that's true.
Previous generation.
Yeah.
If you have 1 crore today,
Yeah.
it's not going to be enough to live well for 40
Exactly.
years.
So I tell them, Mama, it's not enough. It's like, what you're saying, it's not enough.
Why do you need more?
Why do you need more?
Because they don't envisage how medical costs will change, how education will
because
change,
they are living through it now.
how
and they think they
lifestyle
can
will
manage.
change also, they don't think through. So they are assuming at their level that it is sufficient based on their muscle memory in costs.
Yeah.
They are not seeing the future. Like in fact, many of these people may not even be eating out now. So
Could
they
be.
won't even know what it costs to have a
be.
breakfast per
Yeah, could
person
be.
in a good place.
And not so much travel also, which I do a lot. So
So I think we are at a time when a young person or somebody in his middle years, let's say in his 30s or 40s, has to think big. There's no choice.
Yeah.
And he has to position a number in his mind. And he has to at least save 1/4 of that number himself. And the rest of it should come from compounding. That's my thumb rule today.
Yeah.
So at least 1/4 of the money is your money. And the rest of it should come from compounding for a big number.
Yeah.
But 1 crore is a saving target which every person should have. You save 1 crore, then the big number is automatically going to come into your life.
Yeah.
If you're just trying to create a portfolio value of 1 crore, you're going to save far less than
Far
your
less,
potential.
yes.
Then you're slowing yourself in your journey towards that bigger number.
Yeah.
Therefore, I set 1 crore savings target. And when somebody learns to save 1 crore, after that his next crore will get saved much faster.
True. Yeah.
Okay? Then it's just another 50 to 100 lakhs to complete his entire savings cycle that is needed to create $1 million.
Yeah.
So, you see how these get tied in.
Yeah.
They're very, very critical. So, it's not a hook that we are putting for videos to get watched, nor is it a gimmick to make people come and onboard themselves into the program. It is a playbook in which these numbers have meaning.
Yes.
Each number has a message, and that message is what will take us to where we want to be.
Exactly. Okay. So I did touch upon this survey which we did for Financial Freedom Day on July 1. Another interesting aspect about youngsters came out in the survey. People in the 20 to 30 age group typically tended to start investing in stocks or mutual funds much later. And then people in the 30s and 40s regretted about having a late start. Now, when we look at a playbook for $1 million milestone, how much, will a late start impact this $1 million milestone a lot? Or can people still make up even if they start, say, in their mid 30s or late 30s or so?
Okay, you're only looking at the late start. Now let me flip it and say, let somebody in their 30s, his absolute saving power in rupee terms is way higher, right? So, he can easily accelerate himself from there over a 10-year period, right?
Okay.
He can easily accelerate himself.
Okay.
Yeah, it may take 15 to 18 years to achieve what he wants to, but if his career does very well and his lifestyle is kept in good control cost-wise and his savings rate are high, let's say 50-60% or even higher, and his investing is very sharp and very, very precise, I think that he can definitely accelerate himself towards $1 million. It's a matter of time. I think you also have to remember that the best phase in a lot of people's careers is between 35 and 45.
Yeah.
They should make full use of the peak career. For some people, it's between 40 and 50. It all depends on the industry.
Yeah, that's very
So let's not take one industry of like IT and generalize, but there are other industries where 40 to 50 is the peak phase.
Yeah.
So whatever is the peak phase, you should use it fully to accelerate your saving and investing. And even if you're a late starter, that acceleration will make up for a lot of lost time. But it won't make up for all the lost time. For that, you must be lucky to achieve superior compounding. Let's say instead of getting 12% return, you must be getting 18% return. But I don't think that's the starting point. You can't start with the thing that now I'm starting late. So if I have to reach faster, I'm going to aim for 18. Then you'll make mistakes.
Yes.
You'll lose money. That's when people take high risk and lose capital.
Yeah.
So you set your targets modestly and keep accelerating towards those modest targets. Do a few things right along the way and try to improve your investment performance through very measured and calibrated actions, not through rash and aggressive investment strategies.
Okay.
So you can still do it. You will still do it. It's a matter of time. Because you're earning more money, even though you're a late
savings
starter.
should be higher rather than your return.
When you're earning more money, higher savings, better investing, and superior compounding will still get you there.
Okay. If you build behavior, save to your potential, and get your asset allocation right at all times, $1 million is well within your reach. Never mind the friend who got lucky with ESOPs or the uncle who had family wealth to back him. Making every investor think big is our mission. And on that note, thanks a lot for watching. See you in the next episode of Decode.